This advice is general and does not take into account your objectives, financial situations, or needs. You should consider whether the advice is suitable for you and your personal circumstances. Before you make any decision about whether to acquire a financial product, you should obtain and read the relevant product disclosure statement. Welcome to our GFM Wealth Advisory podcast. My name is Patrick Malcolm. I'm a senior partner at GFM. I'm joined by Sam Eley, our senior financial planner.
How are you?
Yeah, good. You, Sam?
Very well.
Good. And we're very fortunate to have Cory Martin all the way from the US of A from Barrow Hanley. Thanks, Cory.
Thanks, guys. Thanks for having me. Happy to be here.
Okay, so for our guests that haven't heard of Barrow Hanley, investing all the way since 1979, can you tell us a little bit about the firm and what's stayed, consistent in your investing approach over time?
Yeah, so the firm was founded by four original partners, Barrow Hanley, Mahoney, and Strauss. All the guys came down from the Northeast pretty much to start the business. And we've always been value-oriented, and that strategy has never changed. And so a lot of people have not heard of us because we're about $62 billion. We're primarily institutional with clients all over the world. The average client size is about 150 million, so they're very large, sophisticated clients. And we're happy to be down in Australia partnering with Perpetual and really getting into the family office and advisory business because it's something we haven't done. It's been a lot of fun.
Yeah, great. Cory, your process talks about finding companies that are both cheap and improving. Can you explain a little bit about what that really means in simple terms?
Yeah. So if you think about value investing, I think there's a perception that you're really buying sort of beaten up cigar butts, to use the Warren Buffett term. But it's really much more exciting than that. And so our strategy is to buy good companies that are down for reasons we can identify and believe to be temporary. And when we say good, so we're looking for cheapness on a price to earnings, price to book, and any other valuation metric, coupled with above average profitability. And what I mean by that, and that's good, and when I say good, we're looking at companies that they've stumbled for some reason that we can clearly identify and believe to be temporary, yet their historical rates of profitability, like return on investment, return on equity, earnings per share growth rates, has actually been better than your average company. And if you can combine cheapness with above average quality, along with identifying a stabilization in operating fundamentals, that's a recipe to win. And that's how we've produced alpha. And we've done that very consistently for the 48 years that we've been in the business.
Not quite as easy as you make it sound though, Cory, is it?
No, it's hard. And when you're a value investor and you're using screens globally, most things that are cheap deserve to be cheap. Yeah. And the art around value investing is finding out where the terminal value traps are and avoiding those and focusing on management teams have a clearly articulated strategic plan that you can work with to see that on multiple ways to win.
And that trade-off between, value and quality and avoiding the quintessential value traps, how do you go about avoiding those traps?
Right. So one of the things, so we're running global screens on valuations, on price earnings, multiple different, 5 different valuation metrics. So we know what's cheap and we know where the biggest dislocations are around the world, and we don't care where that is. It could be an emerging market country, Asia, Europe, Australia, whatever, U.S. So we're looking for cheapness, but then we're trying to identify a stabilization in operating fundamentals, which are a number of proprietary screens, but we're really looking for a clear indication that margins have troughed or stabilizing, in fact, maybe reflecting up. Same thing for sales. Maybe we've got a stabilization in EPS deterioration, and maybe we're looking at net pass, revisions, positive versus negative revisions. So those measures of stabilization of operating fundamentals, they won't eliminate getting caught in a value trap, but they will greatly reduce the probability that gives you a better shot of not being caught.
Absolutely.
I would say.
Yeah. So your portfolios typically hold around 50 to 70 companies. Just curious, why is that the sweet spot for you guys? Why not hold 80 to 100 for diversification purposes or 20 to 30 for more high conviction positions?
Yeah. So if you think about all of our strategies, so the global equity strategy sits on top of a really deep and broad research platform with various, so we're really regional experts. So we've got a U.S.-centric research team, portfolio management team running U.S. large, mid, and small cap.
Mm-hmm.
We've got developed market, non-U.S. managing, EFI mandates and ACWI ex-U.S. And we've got an emerging market team managing EM strategies. And all of those are what are supporting this strategy. Over time, all of our individual strategies, including this global strategy, are fairly concentrated. The U.S. is even more concentrated, around 40 to 45 names.
Okay.
EM is 50 to 70. What we found when we developed this in 2010 was we did a lot of testing, and we looked at what is the optimal number of names to provide proper diversification, but also give you very high active share. And so this fund has about a 90% active share. Owning fewer stocks can create a much rougher calendar year ride that a lot of, I would say, if you're running a whole bunch of different multi-managed strategies, that's okay because they're going to balance each other out. But particularly with a high net worth or retail sort of profile, you don't want to have the boom-bust cycle with a highly concentrated version. So we found the risk-adjusted numbers and the volatility measures of 50 to 70 to be kind of in the sweet spot of that.
So not over-diversified, but not taking too much active risk.
That's right.
I guess.
Yep.
So you talk about the approaches blending both defensive and cyclical value. Can you talk us through why Barrow Hanley feel that works through the cycle, so to speak?
Yeah. If you think about the spectrum of value investing, on one end, you've got deep cyclical, deep value names. That's a great way to make money. It's also can be very volatile. Mm-hmm. On the other end of the spectrum, you've got high quality sort of compounding defensive value. Yep. And when you think about market behavior, we get into a risk on rally like we've had recently. You get these cyclical, names, deeper value names really start to outperform. Mm-hmm. And whenever that happens, they become more expensive. And the opposite end of the spectrum, the defensive compounders become cheaper.
Yeah.
And many managers are on one end or the other. That's a great way to invest, but these cycles last anywhere from 12 to 18, sometimes 24 months. And our strategy is we're constantly having to redeploy capital out of the winners that are become more expensive into the area that's underperformed and thus is cheaper. And you can measure it. If you go back over history, those cycles last about 12 to 18 months, as I said earlier. And by doing that, it's constantly forcing you to reset the portfolio where the biggest dislocations are, not in a mechanical way, but in a company by company specific way. But it really sets the portfolio up to provide a little bit smoother calendar year return than being out on one end or the other. So we will never be as cyclical as a deep value manager, nor as defensive as a high quality sort of compounder. Yep. That we're going to be ranging in between those two structures, and that's a little bit different than a lot of our peers.
So at the moment, you're seeing a lot of concentration in global markets, particularly at the top end, around the large US tech companies in particular. I'm just curious how you view that risk at the moment, the concentration risk element.
Right. Well, certainly those names have been the place to be for the last 10 years, the hyperscalers and all the things that are happening now. They've been gaining and in their dominance of the behavior of the market weighted index to a point where now the MSCI World is about 24% in the top Mag 7 stocks. And I think
that's crazy.
People really are just now starting to wake up and to realize like how much exposure and how extreme the concentration has been and is now. And it's making people nervous. And if you think about the average growth manager over the last 5 years has dramatically underperformed because of the concentration of that market cap. Our strategy doesn't look anything like that. So if you look at the median market cap of our strategy, it's something like $80 billion, or the weighted average market cap relative to the broad market, which is like $850 billion. And so it's the most extreme concentrated market we've ever seen. There's risk in that. So it works great when the indexing strategies are piling in, self-fulfilling. But when the earnings growth starts to decline, which it is now, it's not collapsing or anything in the Mag 7 or the hyperscalers, but with the CapEx spend, and we can talk more about that later, you'll start to see that's going to dominate the performance pattern of the cap weighted index. And so it's reached an all-time extreme, and we expect that that's starting to unwind. The market's broadening.
You mentioned before that people are getting a little bit nervous perhaps about that concentration risk of the 24%. I mean, we saw that sort of play out a little bit a few years ago. I think people sort of seem to think that these companies will just keep growing and growing and growing. At some point, something will happen, whether it's the high inflation element or whatever it is. We saw the NASDAQ drop considerably, a few years ago even. So it's not like they're immune from these swings.
And I think, a lot of investors realize, down markets really matter.
Yeah,
and so
absolutely.
in that 2022 period,
Yep.
I mentioned earlier, we have a very high active share, and we also have a very high correlation to the value factor. And during that period, we were down something like 4%. Don't quote me on the exact number, but the market was down 20 plus, mid-20s.
Yep.
But a lot of our peers were also down with the market.
Yeah.
And they're value managers.
Yeah.
And so, we do exactly what we say. We don't deviate and go out and barbell the portfolio with high growth companies and deep,
What it says
cheap
on the label.
cyclicals. So what we do is what you're getting.
Yeah.
And I think the really important thing with that is that to the extent that when the market starts to recover and the client's got 96 cents in the dollar and they're compounding off that base rather than 80 cents in the dollar, and I think psychologically for investors as well, that the market's fallen but you're down 4% versus the market being down 20 is huge.
Yeah, and you take the first quarter of this year. Our fund was down about 80 basis points and change versus the market that was a little over 6.
Yeah.
And so these periods can be very quick. Having said that, we do protect on the downside, but we also participate on the upside. So if you look at our 10-year number, which this fund is not that old, but our institutional separate accounts, we've captured about 120% of the up market and about 94% of the down market. And so we're participating in the up markets, protecting on the down market. And then when you do get an exogenous shock where you get a PU compression, like we just saw in the first quarter, we saw in 2022, I expect we're going to see that in a greater occurrence going forward. You're going to see that protect.
Yeah. Maybe to pick up on that, you're not significantly, you're underweight the US versus the global index. Cory, do you want to talk us through why you think that's important, why the portfolio is positioned that way? I don't know. We know you guys are stock pickers and you don't think about, we want to be underweight the US, but why it's played through from a portfolio construction perspective.
Yeah, so we actually were pretty heavily invested in the US up until a couple of years ago, and it became such a richly valued market that we began finding much cheaper opportunities, particularly in Europe, and a lot of cyclicals in Europe and some of the European banks. But when you think about what has happened in the outperformance of non-U.S. developed markets and emerging markets, the relative valuations in the U.S. when you saw this first quarter multiple correction, it really did compress 3 or 4 or 5 multiple points. And it kind of, with the broad market broadening out in the U.S., we just felt like there actually more opportunity. But so now we're about 60% U.S., but that's far below the MSCI World, as you're indicating. But we will move the portfolio around from a bottom-up stock selection. As I mentioned earlier, the screening process, we're going to go anywhere where we see the greatest dislocations and the best risk-reward opportunity, and the resulting weighting will be a result of that individual company moves, and you aggregate everything out up, and that's where we end up.
And are you underweight the US because you underweight the US tech stocks, or is it a bit more nuanced than that?
Primarily. So if you think about the market cap contribution of the top 10, not just the Mag 7, Eli Lilly, JP Morgan, these huge, basically trillion-dollar companies, that's primarily why we're underweight. But we're finding, despite the fact that the U.S. is still pretty expensive relative to the rest of the world, if you strip out the Mag 7 valuations and some of these crazy names like Palantir, and they're selling at 100 times sales, NVIDIA, there is a lot of opportunity in the other 493 S&P 100 stocks, or 493 stocks in the S&P 500, or whatever.
I think we're on to 8.
Yeah, cool. You've touched a little bit on this, Cory, I think through some of your answers there, and you've highlighted a bit of a gap between the value and growth stocks, and that the gap is historically wide. From an investor's standpoint, why does that gap between value and growth matter so much?
Yeah, so if you look at our performance over the past 5 years, our global strategy has actually beaten the broad market without owning these
big seven.
Very tough
Max
to
7. Very tough to do. Good stock
Because
selection.
all the managers like, we've underperformed because we haven't had the tech stocks.
I know, and so I feel really good. I mean, we haven't killed it, but we've outperformed without having to own that stuff.
Yeah.
Having done that, and we talked about U.S. exposure being more expensive, we're still at one of the greatest discounts. So we're at 13.6 times earnings relative to 18 times earnings for the MSCI World benchmark. Yet the gap between the valuations are at all-time extremes. And so the reason that's so important is your average investor doesn't realize that your future returns are all about the entry point valuation. And so right now, we're at 13.6 times. And so I can actually measure this and show you the 5, 10, 15, and 20-year forward returns from this level.
If you buy it at that level.
Yeah, they're almost twice as high, so it's around 10% on the 20-year expected return if you're coming at this level versus 5% where the valuation currently stands for the MSCI World. So entry point's very important. Not only just if you're indexing, it's really important, but if you're actively managing an account, it even makes value more appealing right now. And we can talk about some of the reasons for that.
What was I think you sort of touched a little bit on it there, but what were some of the reasons behind your strong performance despite not owning the Mag 7? So what were some of the key sort of attributors to that performance?
It was really just stock selection. And fortunately, we were participating in the CapEx boom cycle for AI and data centers, but it wasn't apparent. And so
you didn't realize it.
Yeah. And so the average investor, if they looked at the portfolio, they go, well, how is this value manager participating in the CapEx boom, the $700 billion next year, 2026, it's happening. Well, our first, a great example we bought at like 12 times earnings, Vertiv. It was a mid-cap industrial company. Just so happened to be the largest provider of liquid, non-liquid cooling systems for data centers. And this is way before anyone was talking about it. Our analyst said, look, here's a little company that's really cheap. I think data centers are going to grow mid-single digits just off cloud support, and maybe we ought to buy it. Well, we bought that at $12. It's now $384.
Yeah, wow.
Disclaimer, we sold it a while back because it became very, very expensive. But so we've really had about 10 names that have participated in the sort of data center hype, the CapEx cycle, but all the names that we've owned have been the recipients or the enablers building the data centers, providing, optical networking connectors and all the stuff that goes into a data center, which I think most people just look at the hyperscalers and that's the data center and the AI.
Yeah.
But in reality, a lot of value companies that are industrial, small industrial, or just differentiated tech, chip companies, we've been very involved in all the chip sector. So all of that has allowed us to participate in all this crazy, spending.
The picks and shovels in the gold rush.
Yeah, exactly.
Yeah.
It's been really interesting.
Good example of a company where you sort of bought it at a value end and then you've exited once it's become sort of more of a growth-oriented stock and you rotate back to find something else, right?
Right. And I was a couple of years ago, if you would have heard me speak or we would have had this conversation, you said, where are we finding value? I'd say, hey, we found value in a couple of chip stocks, not NVIDIA. And it turns out the more work we did, we found about 5 analog and other power chips and other things, companies that were all in the same boat. They had built inventory after COVID. They were destocking. Earnings had been crushed. And yet they had massive upside exposure to the data centers. And so, some of it's luck, some of it's sticking to your discipline and doing your homework.
One of the interesting things when we look at markets historically, Cory, is we go back and we look at the biggest companies in the world in 1995 versus 2000 versus 2005, all the way through to now. They're always changing. It's very, very different. And there are some few unique examples where stocks have stayed there for a long time. But I guess, how does that sort of constant evolution of market indices change or influence your views around investing?
Yeah. So we do pay attention to that.
Yeah.
It is, and you're correct. If you look decade to decade, most times the top 10 stocks by market cap are not there the next 10 years. In the 80s, in 1989, they were all, I think out of the 10, they were all 9 were Japanese, for example. There have been instances like Exxon, Berkshire Hathaway, Microsoft, you probably I haven't looked recently, but probably something like Microsoft may have made it for its third 10-year period, but it's very, very rare.
Unique, very unique.
And if you think about why that is, I mean, the exponential growth of some of these crazy large companies, it's like Moore's Law. It's not doubling anymore.
Yeah.
It starts to deteriorate relative to something else. And the operating leverage in the lower market cap companies actually becomes much higher. And the profitability, you can grow those much more quickly. And so over time, these things don't collapse. They sort of just relatively underperform the market and other things rise. And so, I will say this time, this last 10-year period with these incredible world life-changing companies, I would expect a couple of them to show up on the next 10-year period. But that's not the only way you can make money.
The current environment's probably a good example, but when markets are volatile and things are moving around, what gives you the confidence to stick with your positions that you've got in the portfolio? Yeah,
actually, we love volatility. As a value investor, volatility, it's like, candy. So, we get through periods of shock. So during COVID, the whole market's down. And for us, instead of freezing, we look at what we're holding. And if the whole market's down and we can swap into a much higher quality, better business, then we'll swap during these periods of volatility. It provides an opportunity that in a normal market environment, you can't do that because the better opportunity is too expensive. So we like volatility. We do have a 2 to 4 year holding period, generally speaking. But, we tend to, our turnover goes up during periods of volatility because we're very methodical about sometimes we don't do anything, but if we can exploit the dislocation, the temporary dislocation, which we did during the tariff issues, and we did to some degree during Iran when the war first started. So that's kind of how we view volatility, and we've all been around a long time. And so if you're buying good companies, they're down for reasons you can identify and clearly understand. You're looking at a normalized earnings power of the company. Just because the market's selling off, you really just don't panic. And you may add to those positions at a cheaper price.
Makes sense.
Now, we know value managers love talking about stuff on sale, Cory, but the sell discipline, can you talk us through that? So what are the things that you're looking at when a stock sort of moves into that sell territory and your discipline or the firm's discipline around that?
Yeah, so whenever we enter a new name, we spend an enormous amount of time building a base case and a bull case and a bear case, and then we do sort of a hyper bear black swan, COVID type scenario.
Yeah.
And the reason we do that is we, every name that we own, if we get into we know a typhoon's coming somewhere, almost like an insurance company. We don't know when, we don't know what company it's going to hit. We want to make sure that if we do get into that situation, that can the balance sheet withstand, a really, really bad scenario. So having said all of that, our sell side is very disciplined. And so we actually, when we put a name in the portfolio, we're tracking we have a price target. And that price target is not crazy. So we encourage the analysts to go back to what is the normalized earnings power? What's a median multiple? Depends on what the valuation method is, and how much upside on just going back to the long-term median can we get? So we're tracking our performance very carefully on what is our return on invested capital been. So how much have we made on the stock since we put it in relative to the price target? And as that approaches, as your stock price approaches the price target, the downside risk becomes
much higher.
Yep.
And so we're very disciplined about sticking. Sometimes the price targets move, but we don't really move them a lot unless there's a major strategic shift or something at the company. So we're very disciplined about taking that capital and redeploying that into maybe a name that hasn't moved much from the original investment theme. And so our sell discipline, and that's when things are working. When things aren't working, I think we do a pretty good job of let me give you an example. We require, if a stock's down 20% since we put it in the portfolio, we require a meeting with the analysts. We re-underwrite the stock. Is your thesis broken? We also call in the biggest bear we can find on the sell side, and we meet with them and say, what are you looking at? So we spend a lot of time on risk and understanding those sorts of things. But I think we're unemotional about admitting, or this is thesis drift, or we're just wrong. Let's bail out. And, even if we're at a loss, because it's our job, we're paid to put on risk, but we're also paid to be good capital allocators.
Absolutely.
Yeah.
And if we're destroying capital, let's admit it. Let's move on. Let's take what we have left and let's see if we can get something that'll execute more quickly.
I think you've answered a bit of my next question, which was around, how do you avoid being emotional or making emotional related decisions around some of the stocks? And it sounds like it's more around that discipline or the bull bear case that you're talking about. But can be probably challenged at times when markets are moving quite quickly and it's volatile, and maintaining that discipline is important by the sounds.
Yeah, it really is. And I've been in the business a long time, and I think we've all seen, any kind of knee-jerk reaction. So the founder of our company, on a really bad days, he was a chef also, a really incredibly brilliant guy. And I remember I was young. I was like 29. I remember going through the tech bubble and all the noise that was going on.
Yeah.
On some of the worst days, he would just say, "Don't make any decisions today. Let's go to the movies." Because he knew, and he was a 70-year-old man. He'd been doing it for years. One of the worst things you can do is make a decision an emotional decision in a really tough market.
Yeah,
better just to sit there sometimes.
So, in terms of looking globally today, Cory, where are you seeing the most compelling opportunities? Very happy for you to talk through a couple of stock stories if that helped with the narrative.
Yeah, I think it really I don't know if you know who Hansel and Gretel are. That's an old German. So we're going around the world, company by company, looking for opportunities. So really, I mean, they're all over the place. I mean, we've recently bought a couple of names here in the U.S. We bought Nokia more recently, which
interesting.
Which
flashback.
So I know. So if you think about it, the average person thinks Nokia. Well, that was the failed kind of handset company.
Yeah,
it's my first phone.
That basically went out of business. And I'm actually they're right, but they sold that handset business in I think it was 2014 to Microsoft. So Nokia has completely transformed itself. I mean, we bought it at like 11 times earnings, and it's transformed itself into a optical networking really dominant player globally, which is really needed in the data center growth all over the world.
Yeah, wow.
And so that's one name we look at. We find opportunities like Hewlett-Packard Enterprises, same thing, low double-digit multiple that has transitioned from a hardware company into a all things AI service company with data center capabilities also. And so, I mentioned cheapness, above average quality. We're looking for change catalysts or businesses that have evolved and people don't realize it. And so
I think they're two pretty good examples of that. I don't think many people would realize that either HP or Nokia have evolved to that extent. Right. The change in they just sort of think they're maybe defunct technology or something like that. Yeah. But no, they've reinvigorated themselves in other ways.
We just bought GE Healthcare, which is spun out from GE, and they're an oligopoly on imaging equipment with Siemens and Philips, and we've got that at 11 times earnings. And that is that particular company it's a great business that has suffered from cost of memory and some other things that have gone up, but yet the guy running it, the chairman, is a guy named Larry Culp, who was the CEO and chairman of Danaher. And we made a ton of money with this guy. He's one of the best operators in the U.S. And the company's really cheap, and he's already made a move by increasing R&D spending as a percentage, doubling it as a percent of sales. So it's got a backlog of new equipment coming out, and it's really well set up. So the point I'm trying to make here is it's very idiosyncratic or company specific. And it's in all different areas. We've added a Chinese milk company that's the largest liquid and powder supplier in China. Really, really cheap, 7 times EV, enterprise value to EBITDA. And so really we're just, all over the place.
I don't think anyone would have considered Hewlett-Packard or Nokia ending up in a value portfolio 20 years ago. But yeah, interesting times.
Yeah.
I was looking at the fund profile recently as well and just sort of noticed the spread of different industries. And there's quite an even spread these days around, where you're positioning the portfolio overall. I just thought it was quite interesting. So you're sort of not to overweight any particular sector, it seems.
Yeah, no, that's right. We actually are underweight industrials, underweight tech, overweight materials for the first time. So we've really participated in in the gold rally.
Yep.
We just bought Freeport McMoran, which is the largest copper producer in the world. They've got some technology coming out they're already the lowest cost producer of copper that's going to further increase yields. And so as you say. No huge bets in the portfolio against sectors. Probably tech difference is probably the biggest.
Yeah.
But really, it's just a well-diversified geographically and by industry and sub-industry group.
Finally, Cory, if investors listening today remember one thing about successful long-term investing, what should it be?
Yeah, one is those markets go up 2/3 of the time. I mean, that's just a fact.
Yeah.
I mean, you can measure that over time. Depending on your time horizon, two things I would say to that is don't try to time the market. Stay invested. Just if markets sell off, just keep adding to the market. The other thing is when you pick a manager, make sure the manager doesn't change.
Yep.
It's the founder of our company said everybody, every human's a one-trick pony. The key is just finding out what is your one trick.
Yeah.
And our trick is this discipline that I just described to you, never wavering from that. And I think that is key. If something has been working for you, doesn't matter if you're just an investor, or a retail, or high net worth, stick with that plan and don't waver.
Yeah,
Very sage advice. Thanks for joining us today,
Thank you for
Cory.
having
Love
me.
to meet
Pleasure.
you. Thank you.
Cheers.